Welcome back to the Financial Shepherd podcast. My name is Joshua Casey Garland, certified financial planning professional, founder and CEO of Shepherd Wealth Management. Very excited to be back in home studios here today. A lot going on as I am speaking. A lot happened yesterday and over the past week. So we got a lot to get into here. I'm going to bounce around a little bit today, but we are officially springtime, post Kentucky Derby. Hope everybody had a good Derby weekend. How about you, man? I know that you're from Louisville. You're not there right now, but it's clearly a big weekend for all of us Kentuckians for sure.
Yeah, big weekend. I was actually sad to miss all the in the streets block parties and general city revelry, you know,
Yeah, all the debauchery and
all the debauchery. Yeah, yeah. So that was something I was sad to miss, but I made up for it in my own way.
good
Here
deal.
in Nashville, went around, egged a couple houses, chugged a beer while walking my dog, all the usual derby stuff. So
Absolutely. Well, yeah, it was a great Derby weekend. And the very next day after the Derby, I had the Cincinnati Flying Pig Marathon, which is a classic marathon race here. Been going on for 27 years in the city of Cincinnati. Did it with a neighbor friend of mine, and it was the best race I ever had. Hands down, got the time I was looking for, 3 hours and 42 minutes.
oh, that's amazing.
So
Congratulations.
very happy. The goal was under 4 hours, so that was cool. And the weather was perfect. We didn't get rained on, not really. I mean, it was kind of dreary, 50-degree kind of day, but that's what you want when you're running that far. That's for sure.
Oh yeah, that's like
Um,
perfect. Don't overheat. You don't
yeah.
have to wear too many layers and stuff at the same time. So
But the bummer was I didn't get to have hardly any mint juleps. I had one. Obviously, your dad is the king of mint julep making, and
he
I
is.
look forward to it every year. And I only got to have one because I had to get up and go run at 6:30 in the morning with a bunch of other crazy people. But it was cool. Glad I did it, and definitely looking forward to the rest of spring and rolling into summertime here. A lot on the calendar, and excited to experience it all.
Yeah, same. This is my first spring in a while outside of the greater Ohio Valley. So my allergies are thanking me for the first time in a while. It's kind of crazy.
Yeah, it's that time of the year. I'm kind of used to it. Don't have those particular allergy issues like my wife and kids do. So, but I am looking forward to some Cincinnati Reds baseball. If you haven't been watching the Reds, you should. It's a lot of fun to watch these young guys play. They're really good. Pitching's awesome. Hitting is up and down with a bunch of guys in and out of the lineup. But really cool stuff here in Cincinnati, man. I got to say, lot to look forward to. And like I said, I'm looking forward to experiencing it all. But today is not a discussion of tourism here in the city of Cincinnati. Today is all about some current events. So if you're new to the program, welcome. Please like, share, subscribe to Shepherd Wealth Management Podcast, your friends, family members, and coworkers. This is a value add show. What this is all about, the reason why we're here to do this, is to provide some context that the news chooses not to really talk about very much. The news does a really good job of bringing things to your attention. They're generally very fearful. The reason for that, us human beings that consume the news, we're all hardwired with a lot of emotions, but two in particular called fear and greed um, are the main drivers of a lot of decisions that we make as human beings and as investors. There's a study called behavioral finance, which you can get a PhD in, and pretty much every major university these days has already debunked all of what I'm talking about. And that being that humans feel losses twice as much as they feel good about making any amount of gain, which means we're all risk averse by nature. Of course, the news understands that, which is generally why most of their headlines are fearful, placating that fearful side of you as a human. Why? It's because of what I just said. You're going to respond twice as much. You're twice as engaged as you would be if you were just to hear a bunch of happy news. So that's the reason for that. I don't really knock the news for that. That's what their job is. And they're a for profit entity. That's why they want your attention as long as they can have it so they can sell more ads at a higher price. Again, there's nothing wrong with making money. But what they do a poor job of is they never say, hey, this is something that you should be concerned about for these reasons. But by the way, sleep well at night today because we've already been through something like this about 17 other times in the course of the last 75 years. And here's how the market played out 6, 9, 12 months later. You're not going to hear that. And you rarely will hear that if you ever do. And that's what this show is all about, is saying, hey, this is what's, the news is bringing to our attention. This is why it matters. That's okay. But by the way, we as humans, investors, have been through something similar to this X number of times. And here's how things played out 6, 9, 12 months later. Now, past performance is no guarantee of future results, and investing involves risk, including risk of loss. And I have no recommendations for anybody listening to this show today. I only make recommendations for my individual clients who I know very well and sit down with quarterly. And of course, of any securities or companies that we talk about today, we at Shepherd Wealth Management and me particularly do not receive any sort of kickbacks or compensation to talk about their company stock or ETF or whatever it may be. So that's the reason for the show. Please like, share, subscribe to it, and we're going to dive right into it today. So a lot going on. As I'm talking here, we're unveiling, or the White House is unveiling, a major trade deal that's come to conclusion here with the UK. First of many, according to the White House, and I can't wait to gather the rest of those details. But the market's sure liking it, with the Dow Jones up almost 1% and everything else. S&P up almost 1%, Nasdaq up over 1%, Russell small caps up 1.25%. And they're still talking right now. So I don't really know all the details as I'm delivering this to the audience, but I certainly will be writing about it and likely we'll talk about it in a future podcast that we'll do. But one of the things that I wanted to talk about was what happened yesterday, and that is Fed Chair Powell. So, as unfortunately, I'm still talking about this freaking guy. I'd like to know, and I don't know if we have the technology to do this, but I'm sure it exists, of how many times I've had to actually sit here and explain what this dude is saying, why he's saying it, and what the market's reaction should be, given the rhetoric that Fed Chair Powell laid out yesterday. So I don't know as if we have that at your fingertips. I'd say it'd be really hard to do with over 1,000 YouTube posts that we've had over the course of a couple years. But I feel like I've been talking about this guy for damn near 3 years.
Oh, it's been 3 years for sure, at least. This is our 4th year, despite it being our 5th season. You know, we had a hefty amount of episodes there when the company first started during the pandemic. But yeah, I never thought I would say this, and audience as well as you can use this over me for as long as I live. But this sounds like a job for AI to go comb through our previous 87, 80
That's
something
right.
episodes and thousands of podcasts or thousands of uploads and look for the times you've mentioned his name.
Oh
So,
yeah, damn right. Yeah, I wouldn't ask you to do that, man. We gotta use AI for that. But
oh yeah.
anyways, I got something to say about AI in relation to Palantir stock. And their earnings announcement, which was just mic drop awesome. So I'm going to come back to that. As please don't let me forget about Palantir
We won't.
and my comments about that, just in case I go off on a tangent relative to Fed Chair Jerome Powell, which I've been known to do. I've been very critical of the Fed chairman for 3 years, mostly. Definitely giving him some grace. I'm not an unreasonable person at all, but the Fed chair is just wrong at this particular moment in time. And let me make the case. This last Friday, before his announcement yesterday, we were pretty sure that there wasn't going to be any announcement for a rate cut, and that's exactly what happened. The market had priced that in correctly. Although I believe he's very wrong, and I'll prove the case here, and we'll see what see how the audience feels about this. But the 2 year Treasury, if you look at the 2 year Treasury, this is seen as the market's expectation of Fed funds rate about 8 quarters from now. All right, so roughly 2 years out. Right, 2 year Treasury yield. In other words, we can view this, the 2 year Treasury yield, as a market based measure of where monetary policy should be. And here are two arguments that support this. Number one, the 2 year yield is 68 basis points below the Fed funds rate right now. So the market is suggesting that the Fed is 3 cuts behind right now. More importantly, when compared to the European Central Bank, the Fed is way behind the curve. Just this morning, the Bank of England announced a 25 basis point cut. So before I even get to the rest of the details I have here today, obviously the UK knew that they were going to have a deal with the United States. They knew that before they made their rate cut decision. But let's just think about this logically for just a second. Any country that the US is negotiating with right now, and central banks around the world, forget China, China's cutting rates too, and all this other stuff. They're all cutting interest rates, all of them, not just Europe, not just the Bank of England. They've been cutting rates across the board. All of those countries have a smaller GDP than the United States. Nobody debates that. So, for whatever reason, their central bankers can understand that, hey, if we don't see through this trade risk headline, we got a freaking problem on our hands here. It's going to be a recession and a half if we don't come up with some sort of way to negotiate a deal that allows our market to do business with the US market. That's what they're saying. And they're cut in the face of the quote unquote uncertainty that our media continues to spout relative to trade with other countries, right? All of this uncertainty is the issue. We don't know if it's going to cause a higher rate of unemployment. We don't know if it's going to cause a spike in inflation. That's what the Fed chairman's words were yesterday as the reasons why we are not making any decisions with monetary policy on yesterday's meeting. Although the rest of the world, even though they would be punished way more severely by not being able to do business with the United States, they're cutting interest rates. So, in other words, they're concerned about a slowing economy. They're concerned about a potential higher unemployment, right? If they can't do business with the US, they might have to lay off some people. China's dealing with that right now. They're also concerned um, that they may not be able to have a lot of future prospects for growth. So, because of those concerns, and understanding that we have to come to some agreement here with the largest economy on the planet. We cannot replace their consumers. We should be cutting rates. The rest of the world. So here we go. Here's my other point. According to the Eurozone data, the European Union core CPI is 2.2%. European Central Bank has been cutting rates for the past 9 months from 4% down to two and a quarter. We're still at four and a quarter to 4.5% Fed funds rate right here in America. And our CPI is right there, 2.4. All right. So 9 months of cutting um, from 4% to 2.25%. And they cut rates in their most recent meeting. I just mentioned that. Also, almost no one has argued against the European Union cutting rates given their CPI is around 2%. Not one person, not one. But yet here we are. Fed Chair Powell, hey, I'm uncertain about the path of unemployment due to tariffs. I'm uncertain about inflation due to tariffs. All these other countries have the same uncertainty, but yet they understand that these high, quote unquote, reciprocal tariffs that have been on pause, all right, the reason why they got on pause is to do the negotiation within that 90-day window and open up the markets in a more fair and balanced way. They can see that and they've been cutting. Well, we're not. Makes no sense. Now, the current United States CPI inflation, as I just mentioned, is 2.4. Pretty similar to European Union. If you remove the shelter component from CPI, and shelter is the largest component of the CPI basket calculation, I've talked about this for years. Go catch any video over the last 3 years, and you'll hear me talk about it on YouTube. But shelter, if you remove the shelter component, which has the longest lag effect, which means it takes the longest for that data point to actually show how monetary policy decisions are impacting shelter, just has the longest lag effect. If you remove that, which by the way, that shelter component has been falling like a rock every single reading so far this year. And we've talked about that in pretty much every podcast that we've done this year in 2025. Shelter's falling. But if you remove that shelter component, the US CPI is 1.8% below the Fed funds rate. This is 40 basis points below the European Union at 1.8%. 40 basis points. But the Fed fund rate, of course, is still kept at four and a quarter to 4.5. The US Fed funds rate, as of this moment in time, is 225 basis points above the European Union. And they have a smaller economy. They have more concerns than we do. In other words, they're cutting rates under those circumstances. We're not. Why aren't we cutting rates? Well, the Fed chair would say, hey, I don't know what's going to happen with unemployment, even though we don't have any unemployment problems. I don't know what's going to happen with inflation, even though inflation's been falling like a rock. The rest of the world seems to not know either, but they're cutting rates because of that specific concern. So, as soon as we have more and more trade deals, obviously the Fed has nowhere to hide, and the data is screaming that they should be cutting interest rates for all the right reasons, by the way. This is what a soft landing looks like. Unemployment not really affected, and inflation's back to trend. That is a soft landing. They should be taking a victory lap. But instead, he's saying, hey, we're in a good position to wait and see. How horrible would it be? How horrible could it have possibly been for the US economy and its future prospects for the rest of this year in 2025 would be if the Fed cut 25 basis points? Hell, in their last meeting in March, they still said they expected 2 rate cuts. And he was asked that directly in yesterday's meeting. And he said, I don't have anything to say about that. We'll have our summer of economic projections in our next June meeting. That's what he said. It's just unbelievable. This is malpractice. This is not being a pro. A pro would set aside any bias, any rhetoric between himself and the president. And he said, hey, everything that the president has to say in the White House, it doesn't affect our job and how we do our job. He did say that yesterday. He was asked that question directly. But to make this decision to not move when all the data is screaming that you should be cutting 25 basis points, it's 25 basis points. What in the hell would happen if you cut 20? Nothing. You're not going to see a spike in unemployment under those circumstances, and you're sure as hell not going to see inflation spike out of nowhere. Now, what he simply could have said is say, hey, we're going to cut by 25 basis points today. We're still in a great spot. We're probably still a little restrictive, but hey, if we're wrong, we could always reverse the decision that we made here today. Um, he went on to further say, like, hey, we are uncertain about unemployment rate and inflation due to the tariffs, right? Well, the rest of the world doesn't seem to have an issue with that. Matter of fact, you're doing the opposite of the rest of the world. So it doesn't scream I'm being a professional here in any way, shape, or form. It feels like he has an axe to grind with our president here in the United States, and I'm just disappointed that you can't set aside your own personal bias or opinion and just do the right thing. Look at the data. The data you're according to your own 3+ years of me watching you make decisions, you're quote unquote data dependent. Well, the data is suggesting scream cutting interest rates. And that's not what we got from our Fed chairman at all, which is very disappointing. But thankfully, we have a meeting next month in June, and we'll see what happens then. Because if his only reasoning for not cutting rates at this moment in time is due to uncertainty regarding trade deals, well, you got one today. It seems like you're going to continue to get more and more of these as time goes by. So that's what I wanted to begin this particular uh, podcast with here today. And as don't let me forget about Palantir, I'll make sure to come back to that. But here's what the Fed chairman also had to say, quote, now we have a situation where the risk to higher inflation and higher unemployment have both gone up. In whose eyes? It had to be your eyes, right? I mean, I don't understand that because you're not seeing in any of the hard data. And quote, as we noted in our statement, and we have got to monitor both of these, Powell said, adding that the Fed may have a situation where there may be a trade-off between the two. This is a lot of maybes, ifs and buts. It's driving me insane. You guys are supposed to be professionals. Okay. You should be able to look at data and make decisions like the rest of the world is doing, all at the same time. They're walking and chewing gum, if you will. But the Fed is choosing to just do one at a time. And by the way, by the time they actually know, like when they feel like they really know what the outcome's going to be, they're already too late. Unless you're telling me that you're going to cut interest rates by, larger percentages instead of 25 basis points, maybe you're doing 50. But then you got a lot of explaining to do. All that quote unquote credibility that you're trying to hang on to is going out the window second by second. I mean, it is. I want to laugh at it, but it's so aggravating. I can't enjoy uh, any of this at all. Now, I've talked a lot about soft data. Again, soft data would just be consumer surveys like, hey, Ez, how do you feel about inflation 1 year from today? How do you feel about the economy 1 year for day, 1 year from today, et cetera, et cetera. Those are soft data surveys. Those are good things because it's more real time about how you feel about whatever the question may be. But again, we are humans. We are hardwired with a lot of emotions. Fear and greed are main drivers of decisions, especially when it comes to our money. Now, I am a consumer of data. As I mentioned on many occasions, we get a lot of data from a lot of places: Barron's, New York Times, Investors Business Daily, Sentiment Trader, Fundstrat. I mean, I could go on and on. All right. I don't have all day long here to list the sources of every piece of information that we gather. But this one specifically comes from Barron's. And this is the most recent Barron's, by the way. So this is May 5th. So a couple of days ago, I got this in the mail. And right in the center of Barron's, kind of like their main article is always pretty much right in the center there. Here's the title: Big Money Poll. So it says 32% of respondents are bearish on the outlook for stocks over the next 12 months, the highest percentage since at least 1997. And on the other hand, nearly 75% of survey participants say their weighting in fixed income assets is higher than 6 months ago, meaning they're sold stocks and bought bonds. And 70% say that they are bullish on bonds. Interesting. Now, this big data money poll, by the way, are professional money managers. This is not retail investors. So this is the quote unquote smart money. Let's just see how smart this money has been as of recent. And here's the question. These are soft data kind of questions. So again, hard data would be things like the CPI number I just gave you. It would be things like the shelter component that make up or one of the drivers of CPI. It would be corporate earnings. It would be the unemployment rate. Those types of things are hard data points. Soft data question that came up here in this particular survey. Describe the investment outlook for US equities in the next 12 months. 32% are bearish, 42% are neutral. That's a big percentage. Only 26% are bullish. I have fallen to the bullish camp, and I've laid out all the reasons for that. And it has nothing to do with any bias. We take a process here of looking at the market through a lens of history for our customers. And the reason why we do that is we want to remove emotion, these feelings. I might feel the same way that some of these fund managers do, but that doesn't mean that you're right just because you have intuition. Well, if you understand where your intuition's coming from, you would understand that you're twice as likely to feel losses as much as you feel good about making a gain. So that's why we need to have a process as investors that removes emotion. That is the number one reason that Warren Buffett, the best investor of all time, walking away, by the way, very sad, but well deserved. Number one reason the best investor of all time says that you, as an individual investor, have not achieved the results that you're looking for consistently over time is because you have no control over your emotions, your temperament. Well, how do you get control over that? Well, understand how other human beings have behaved under similar circumstances, and that puts everything in their proper context. You no longer are emotional. You can clearly see, hey, the market did this 6, 9, 12 months later. Well, there's 11 sectors that make up the US stock market. What did the best? What did the worst? What did okay? Now, again, there's no guarantee that history is going to repeat itself, and you can certainly lose money by making any investment decision, even if you use this process. There's no question about that. But this process removes emotion, it puts things into the proper perspective. And as the individual investor, you can now see what the real risk is and what the reward might be for making those decisions. That's exactly what everybody needs if you're looking for consistent results. But if you're a smart money manager, you feel pretty crappy about the US economy 12 months from now. I bet you do feel pretty crappy because there's a really high likelihood, given that you just said here in this title, that you sold stocks and went into bonds over the last 6, 7 weeks as the market dropped. It did drop, the fifth fastest it's dropped since 1950, right? And you sold stocks, you went to bonds. We all saw the recovery. We were right back where we were before Liberation Day. And you missed it all. We bought, not because it was the contrarian thing to do just to be a contrarian. We pointed to a ton of historical data that suggested that this is highly emotional driven sell off. We pointed to it and proved it. Go back and listen to any of our YouTubes from earlier this year. And we bought, not just to be the contrarian, but because we were able to point to historical data reasons and explain exactly what the risk and reward might be for the decisions that we're making. Obviously, no guarantees. Investing involves risk. Right? And these guys are piling into bonds and they missed a run up in stocks. I bet you do feel pretty bad about that. Some more questions. What is the biggest risk the stock market will face in the next 12 months? 24% say economic slowdown, 19% say recession. How in the world, you're a smart money manager, how in the world do you get recession with an unemployment rate right around 4%? How in the world do you get to recession when oil is under $60 a barrel? How in the world do you come up with recession when corporate earnings are breaking records and profits? I don't know. Let's keep going on here. Are clients bullish or bearish or neutral about stocks? 37% say neutral, only 7% say bullish, nearly 60% bearish. And valuation. Is the US stock market overvalued, undervalued, or fairly valued at current levels? 58%, nearly 60% say it's overvalued. Based on what is what I would have to say. And hey, how about a simple one? Will stocks suffer a bear market in 2025? 65% say yes. And why is that? It's because of tariffs, right? 80% of the people say it's because of that. I can go on and on. There's a bunch of crappy questions in here and obvious answers from these extremely biased, um, smart institutional money managers, right? So again, folks, if you're looking for an edge, it's not going to come down to how well you can read a balance sheet and income statement, cash flows. It'll have very little to do with your ability to do research on the company's board and CEO. None of those, pulling off here. Palantir. Palantir is a artificial intelligence software company. They do both government contracts, private company contracts, and everything else. And it is a darling of Wall Street. I mean, just substantial performance over a long period of time. Its valuation, however, as we're sitting here today, and it just got done with a mic drop earnings announcement just a couple days ago. Um, they're like 65 times 2026 revenue, their price per share, right? So you could say overvalued to the hills. Definitely have that. If and again, all the people that said this, they went to school just like I did. They all read The Intelligent Investor just like I did. They all got an MBA just like I did. I understand when you read something like The Intelligent Investor and you go to college and finance for a long period of time, they're going to say, "Hey, you'd love to buy undervalued stocks, low PE ratio." There's all this historical data. Low PE ratios do better than higher PE ratio stocks over a period. I read all of that, and Warren Buffett built a phenomenal career using that process. But you got to keep in mind, back in those days when The Intelligent Investor was written, there wasn't a tech sector. It was manufacturing and banks. That's all there was. So certainly things have changed over the course of time. And the largest companies here in the United States and around the world are right here in the United States, and they're mostly tech companies. Obviously, Berkshire is a part of that. They're not a tech company. They're just an awesome company of a whole bunch of different businesses, right? But the biggest ones, the majority of them, are tech. And if they're the best companies on the planet, they deserve a higher premium for owning their shares of stock. Nobody debates this. If you were to just say, I'm only going to buy undervalued, low PE multiple stocks over the last 15 years, you missed them all. Amazon's never had a good PE ratio. Let's see. Nvidia, pretty high PE ratio. Microsoft, Google, Apple, they've all traded at higher PE ratios than their peers, than the historical average for the tech sector, than the S&P 500. You would have missed them all. So to just sit there and pound the table after Palantir not only dominates top and bottom line numbers, both on revenue and earnings, way above what analysts were expecting, they raised their guidance and the stock went to sell off 13% right after that. And it's recovering and will recover here. It looks like, in short order, as we anticipated. But we are big fans, big fans of Palantir. And the weird part about it was, help me square this round hole here.
Let's do it.
Um, so Palantir did earnings after the close a couple days ago. Stock is up about $124 a share. Now, these quote unquote smart money managers, I mean, they hated this stock when it was trading in the 30s. They said overvalued. It got up into the 50s, really couldn't stand it. They despised it at $100. So it runs up to 124 before its earnings announcement, by the way. And post earnings, again, mic drop, top line, bottom line, raise guidance. I think the exact quote was, "It's a titanic shift," from the CEO, saying that our business is perfectly in line with the next generation of artificial intelligence. And the stock sells off 13%. I mean, you got everything that you wanted: top line, bottom line, dominant beat, and raise guidance. And you're hearing the CEO saying, "Hey, we're so damn demanded. I can't even see the end of it." It's much like what Nvidia had to say 2+ years ago when they dropped a mic drop moment for Jensen Huang, the CEO of Nvidia, and the company itself, led them to $1 trillion+ valuation here today. And the other thing is, all these smart money managers that are throwing shade and cold water on a company like Nvidia because it doesn't trade at the perfect undervalued 16 PE multiple, right? Or saying, "Hey, it's just overvalued." The fundamentals are there, though. The fundamentals are there, but we just want to look at, things that are undervalued relative to their peers, right? That's what they're saying, because they missed it all. They missed the whole thing. Their bias is now in the way of them making a better decision for themselves. They're the only company, by the way, right now. You can maybe say Microsoft, but right now, I mean, Nvidia makes the chips that powers all this AI stuff. So let's leave those two companies maybe to their own little category for this moment in time. But right now, everybody, including other CEOs and the news media, are saying, if we're going to continue to spend this much money on Nvidia's chips and data centers and artificial intelligence, we need to see a return on investment, right? We need some ROI. Well, that's exactly what the hell Palantir delivered. They're the only company, in my view, with the investments that they made in their business, in their AI, with their software. They are showing you in that earnings report that they are getting huge ROI for making those decisions. And you've heard nothing but every large tech company saying they haven't slowed down spending on AI. They haven't slowed down on spending on the data center. None of that. I mean, you cannot find one hard data point at this moment in time that leads to the majority of the quote unquote smart money managers leading into a recession. It's unbelievable. This isn't journalism. This is exactly what I said at the beginning of this. This is a bunch of human beings, and that's what makes a market, is human beings. And they feel very differently depending on their political perspective about the future of the economy. Although you cannot find one hard data point. And these dummies missed all the run up because they bought bonds. So just understand where you're getting your research from, and understand kind of the whole perspective that the people that write this stuff are coming from. Because if you were to just to look at this, which a lot of people do, by the way, I mean, Barron's, it's freaking Barron's. A lot of people are going to take that advice and say, "Oh man, these guys are smarter than me." All right, but based on what? They're not pointing to anything. They're not pointing to one thing. And they might throw a valuation out there, much like I said with Palantir. But again, they missed it. And if you listen to them over the course of the last 15 years, you would have missed them all. Even Warren Buffett himself finally came around and said, "Yeah, I probably should own some Apple." After doing some homework on all these tech names, I'm come to the conclusion, even though it's trading at a much higher PE ratio than I'm personally comfortable with, this being Warren Buffett back in the day, When he finally came around to buying Apple, and everybody said he was late. He might have missed the first 15 years, but he sure as hell caught the last 15, right? Remove your emotions and your own personal bias, and you'll find a tremendous amount of consistency and success over time. You'll sleep better at night. And there's a really good chance you're probably going to beat the hell out of all your friends and neighbors when it comes to things like investing. Obviously, there's no guarantee of that, but that's why we go through the process that we do here for our customers at Shepherd Wealth Management and saying, hey, these are from the words of the greatest investor of all time, these are the things that we need to solve for. That's what this program and our writings to customers and our quarterly reviews and all the things that we do for them is all about. It's not just to give me something else to do. I don't need anything else to do. I have 3 daughters, 2 dogs, a wife. I got other things going on. I don't need to do this, but this is how I've found I've been able to control my emotions over time and make good decisions. And it's certainly working well for our customers as well. So I really hope that you guys like this program. Please like, share, and subscribe to it. Share it with your favorite friend, family member, coworkers. And we'll bring something to the table that the news isn't. I think that they'll find some value out of that. So this is a lot of fun for me to do. I got to have some fun here today, even without any notes. As I mean, this was just like off the cuff because we sit here and we read and study about this stuff all the time. We don't need notes. It's just part of what our DNA is here. So I enjoy doing this. We'll do this about every 2 weeks. I hope you guys can be around for that. And in a couple weeks from now, we'll be at the end of May, right? Yeah, it's coming up on the end of May and getting ready to roll into summertime. So I'm looking forward to that. If you have any questions, please leave them right here in the YouTube chat, or you can go to our brand new website, by the way. Forgot to shout that out as it's pretty
Almost
badass.
let that slip by, man. That's the big
That's
news.
right. Really good news. New website, shepherdwm.com. Really cool. Shout out to John Lucas if you're watching. Did a great job. Really appreciate everything you did there. He created our new website, and go check that out. You'll find all the information, background about the company, myself, my president and business partner, John Ashcroft. And of course, if you have specific questions, love a more direct conversation, you can call, text, or email us, and all that contact information is right there. So, as this has been fun, we'll do this again for the audience in a couple weeks. Hope you guys have a great rest of your Thursday. God bless, and have a good weekend as well. Take care.